Hi, everyone. Welcome to today's webinar. I'm joined by a special guest. And we're excited to have you all here too. Today, we'll be talking about investing in rural and emerging opportunity zones, and really excited for our guest speakers, Chris Montgomery and Sarah Brigato. We can go to the next slide, or I'll show the agenda and what we'll be talking about today. Of course, we'll also be joined, or we also are joined by Rachel, our wonderful moderator for these OZ webinars. For today's agenda, we'll start off as we always do with OZ updates, and then we'll go into a topic overview, presentations from our guest speakers, and then finally we'll do a Q&A at the end. So just a couple of housekeeping notes too. If you have any questions throughout the webinar, please put them into the Q&A box. It's a little bit easier for us to track and make sure we don't miss anything, as we often do in the chat if that gets a little busy. So again, just use the Q&A function to put in any questions throughout the presentation. Some of them we'll try to answer live. Others we'll make sure we get to at the end in the Q&A section after the presentations. Also, this is being recorded. We will have a posting of this recording and a recap of this discussion up on our website within the next couple of weeks, and we'll make sure to send that to everybody who has registered for this event. Go to the next slide. All right, so we'll start off with OZ updates. So a couple notable updates since our last webinar in October. We have sorry, my special guest keeps wanting to join. We have an update from Novogradac on investment trends through Q3. And interestingly, we are on track for a more than $10 billion a year equity raised. That's the first ever since Novogradac has been tracking opportunity funds through their survey. So that is notable. However, the number of opportunity funds tracked and who have reported raising equity in the quarter also grew. So notable as well, in that may explain the rather large uptick from Q2 to Q3, which was about $2.2 billion raised in Q3 alone. So that brings the total aggregate number of the size of the market, at least what they're tracking, to almost $33 billion. And again, they always note that the actual size of the market is probably closer to 3 to 4 times that amount. If you extrapolate, funds that we know are out there, but not necessarily being tracked through this survey. A couple of other, kind of items of note from the survey. As has persisted throughout the history of the market, residential and commercial real estate still dominates. About $20 billion have been raised in each of those categories. And most of the OZ investments are targeted or are raised by opportunity funds that are targeted to either one specific city or multiple specific cities. So one other, the next update is related to the Environmental Protection Agency. They recently explored alignment with OZ investment, which I think is great and notable to see the federal government, really exploring this in a formal way. The Financial Advisory Board, engaged by the Office of Policy, recently issued a letter in September outlining examples, advice, recommendations on how EPA can facilitate attracting investment to opportunity zones. That included pre-development work, better interagency collaboration and awareness, and also priority allocation, especially from some of those large federal funding programs that EPA is part of. For recent OZ stories, so one coming out of Atlanta, the MARTA transportation system, which I think is generally going through a big overhaul and kind of reassessment of how to make it work better, as well as where to put transit-oriented development around some of its stations. So it is really looking and has historically and continues to look at opportunity zones as a tool in service of their ultimate goal of creating a more transit-friendly Atlanta. And so the latest example of this is the Bankhead station. You can see the quote there from the MARTA interim general manager and CEO about that particular neighborhood that's experiencing a lot of significant growth in land use. I think that is nearby where the stadium is. It's also where the new Microsoft campus is going to be. And so calling out specifically how opportunity zones and that designation can make this a really successful kind of transit-oriented development. The development being planned there is 495 housing units with 148 of them designated as for affordable and workforce housing. And the last thing I'll mention before I turn it over to Rachel for our topic overview is an article I believe from ULI, or at least reporting on a ULI event, the Urban Land Institute event, talking about the Inflation Reduction Act and some of the tax credit programs that are included within that. I think an interesting example of how opportunity zones may be able to work well with programs coming out of the IRA is listed here or noted here by Dwayne Desidero from the Real Estate Roundtable about the EV charging, electric vehicle charging station tax credit that only applies to buildings and projects in low-income areas. So, of course, opportunity zones encompasses those places. And so maybe an opportunity there for further alignment between some of these newer tax credit programs established in the recent legislation and opportunity zones. And I think that could be definitely a topic worth exploring and one we're certainly looking into as well. Go to the next slide. Great. So with that, I'll turn it over to Rachel Riley from Aces and Archers to take us through our topic overview.
Yeah.
Oh, and sorry, Rachel. I just was going to say, I will also drop links to everything that we just discussed or that I just discussed into the chat as Rachel's talking too.
Yeah, thank you so much, Catherine and Simone in the background. It's so good to see everyone. We wanted to have this topic on rural and emerging communities. We've done this topic in the past, but I think it's good for us to take a look at the activity that's happening in rural and emerging communities that include opportunity zones, especially given the fact that the Sorenson Impact Center released their Rural Opportunity Zone and Recovery Playbook. We know that there is activity happening in these communities, but there is a perception that the balance of OZ transactions are happening in major metros, and trying to understand that dynamic and why investment capital may be attracted to major metros as opposed to rural and emerging communities is something that we're continuing to look into. Although I think that opportunity zone investors have the same sort of considerations as all capital providers. And so the rural and emerging communities continue to face these persistent issues around being able to attract capital, whether it's OZ investment or not. And that is one of the reasons why I believe that Sorenson Impact Center, along with a number of other partners, worked on the Rural Opportunity Zone and Recovery Playbook. This was an updated version that they released, I guess, probably about 6 weeks ago, but I think it's a really good resource. And I know sometimes, especially right now, as so much federal funding is being made available and everyone has a resource and a guide and a playbook to explore how to leverage capital. Sometimes we just see it, we put it on the shelf, we say that's great, and we never return to it. But I think that this is one, especially if you're interested in attracting capital to these types of communities, that you may want to dig into a little bit more. And I say that for a few reasons. Just so folks are familiar with what this playbook is meant to do and is about. The audience really is rural economic developers and community leaders. And the playbook profiles some of what these folks have done over the past couple of years to attract OZ capital into their communities, and displays those and elevates those as best practices. It recommends 6 concrete steps in order to get from, ideation to investment. And these 6 steps are extrapolated in the playbook. But number 1, they talk about planning for social impact. They talk about building your team, understanding investors, leveraging incentives, and these are federal incentives as well as state and local incentives, creating a community vision and project menu, and then also investor engagement. So how do you connect to investors once you've taken all of these other steps? We can go to the next slide. The things that I want to point out to folks is really high level. What I think they do a great job at doing is basically profiling OZ investor typology, which we'll go into in a second. They talk about deal structuring to overcome a lack of shared language and frameworks between communities and investors. This is something, if you have been engaged in opportunity zones or any sort of community investment strategy, you know that there can sometimes be a disconnect between the way that communities talk about projects and the way that capital markets tend to think about investments. And so how do you structure deals around those gaps in communication in order to get to a yes on both sides? They talk about taking a regional approach, which I think is particularly important in rural and emerging communities where you can scale capacity and certain efficiencies. They talk about attracting local investors. They have examples of local investors coming together to fund OZ projects. And then they also have case studies in the playbook. So take a look at the case studies. Really interestingly, maybe not so interestingly, but I think importantly, they identify the most common types of investments, OZ investments in these rural and emerging communities. Affordable housing ranks number 1, or it's at the top of the list there. Talk about hospitality and ecotourism, which we'll talk about today. Grocery stores, childcare, senior living, downtown revitalization, broadband, business accelerators. A lot of the same types of assets, maybe excluding broadband, but same types of assets that distressed communities in major metros need as well. And so just wanted to point that out, that it's not like rural communities necessarily need something completely different. I think it's just a matter of getting the capital to deals that have been structured in opportunity zones. Go to the next slide. So I know this is hard to read, but I believe Catherine dropped the link to the playbook in the chat. So you head over there and zoom in on these pictures. But when it comes to investor typology, I think the playbook does a really good job of sort of bracketing out the different types of investors that are in the OZ space right now. So they talk about these funds or investors that are community focused and impact oriented. They talk about investors whose motivations are really return driven motivations, and they're looking for a 10-year plus time frame. They talk about investors that are really driven by the tax deferral, as well as investors who just have this one project that they want to invest in. So it's not necessarily like they're investing in a blind pool. It's just they know they want their capital to go to a specific project. So perhaps through a single asset fund. We talk about that all the time. So dig in there. They give examples and break down those typologies for you in the playbook. Then they also talk about opportunity fund typology, which again, this is actually the first time that I've seen the investor typology and the fund typology broken out in these ways. And I think this is across all opportunity zones, not necessarily rural opportunity zones, even if this is a resource or playbook for rural opportunity zones. We are seeing large blind pooled investment funds. And again, these are funds where the investors don't really have investment decision-making capabilities. They're just investing into a pooled fund, and the fund manager or asset manager is making those investment decisions on behalf of the investors. There may be like a certain theme to the fund, or the fund may say, we're only going to invest in this region or in this asset type. But by and large, it is, as an investor, you're investing not necessarily having any sort of certainty about the types or about the project specifically that it'll go to. Similarly, regional or local investment funds. So this is less of like a national blind pool fund. This is a regional or local fund that's place-based or geographically specific about where they're investing. There are funds that are existing real estate development funds or groups. So these are project sponsors that are developers that are, looking to raise capital for their pipeline of projects. They both are responsible or have a lot of engagement around the capital raising piece of it, as well as the actual development piece. And then there's hyper localized investment groups. So this is, again, probably like your single asset fund situation where the community or other investors rally around a specific project or a specific defined area that has a smaller footprint than, say, like a regional fund would have. Again, I think this is great that they show capital stacks, or at least sample capital stacks, and then they go into the definitions. I think we talk about, is this common equity or preferred equity, or, do we need some mezzanine financing or mezz debt? Who's going to provide the senior debt? And we throw these terms around a lot, but the resource or the playbook goes into and actually provides definitions. And then they provide here on a scale of, risk and return. So senior debt being the least risk with the least return, all the way up to common equity. So sorry, we can go back one more. So basically, and they show like the percentage of the capital stack you should expect, or that would be normal to see as part of a transaction or a real estate transaction. All right, we can get the next slide, thanks. And then they also go in and they say, underneath all of these traditional sources of capital, so equity and debt capital, you could have philanthropic investors. You could have local incentives that are providing tax credit equity to the project. So it's basically a subsidy. Or you can have the local incentives are like your TIF, your tax increment financing, any revolving loan funds, and then the national incentives being like the LIHTC, new markets, et cetera, that provides some sort of federal subsidy through either tax credit equity or maybe it's a HUD Section 108 loan that can be offered through the Community Development Block Grant Program. And then in addition to that, I thought it was great that they showed the different types of local tools and incentives that have been created alongside OZ projects, or that can help enhance or boost OZ projects. And so they provide some examples here in a call out box for Utah, but I think by and large, they identify a number of both state and local incentives that could be leveraged in case your community or your state is looking for a way to maybe boost OZ activity or just general investment activity. Of course, I think a lot of these tools can be repurposed outside of opportunity zones, or not exclusive to opportunity zones, but more broadly to distressed communities. And that may be a place where you and your community are at this point. Go to the next slide. So with that, I'm really excited to have Chris Montgomery from 4 Points Funding on. I know that 4 Points was interviewed as part of the development of that playbook, and I was just out in Colorado last week. I'm getting to talk to a lot of folks in Colorado right now for a project that I'm doing with OEdit, and just really thrilled that Chris could join, and looking forward to hearing what 4 Points Funding has been up to.
Thanks, Rachel. So I'm coming to you guys today from my hotel room in Florence, Colorado, near one of our projects. And if you don't know where Florence, Colorado is, that's probably kind of the point. We're investing in rural areas that have not typically been able to attract capital in the past. And thanks to the Opportunity Zone incentive, I wouldn't be sitting where I am today, literally in this town of a few thousand people, without the Opportunity Zone incentive attracting that capital. I often refer to it really as a spotlight. it's not going to make a bad project into a good project, but it is allowing us to focus on areas that institutional capital or even slightly smaller capital stacks have not been able to focus on in the past. So I'm excited to talk to you today, particularly from a rural investor focus. I know Sarah's going to talk to us more from a community focus in a little bit, but I'm really coming to you from an opportunity zone fund investor perspective today. So next slide, please. Quick introduction of who we are. We're opportunity zone focusing on Colorado markets. I'll show a map later talking about where that is. We're raising our fifth fund. We've deployed about a little over $75 million of OZ equity in the last 2.5 years. That was all through the funds Rachel was talking about before, the different fund structures. We are a impact motivated, but return driven fund. The prior funds were all multi-asset funds. The current fund is a single asset fund, so I can talk a little bit about that if there's questions about that in the Q&A section. The first couple of years have been spent fundraising, locating projects, developing projects. We're still in that mode. We're still fundraising, we're still developing, but we've also reached a point of stability and actually operating these projects now. We're focused on multifamily housing primarily, but we also have a hospitality focus. We call it outdoor hospitality. We're located in Colorado that has a lot of beautiful areas. Most of our focus is the majority of the capital is going to flow to the multifamily housing, but a lot of the focus also goes to the hospitality portion of it, which has a larger job creation component. We've established internal housing development team, as well as an internal hospitality team to manage the development of these properties and then the operation of the properties as we move them forward. We've completely deployed our first 4 funds, and I'll show you some pictures even later of some of the things that we've done. But our first housing developments are now leasing up. Opportunity Zone was a concept initially, a lot of water cooler talk. It's nice to be at a place now where we can actually celebrate some tangible success. We can go to the physical properties that we've developed. We are a real estate fund. We're not doing any venture capital or those type of things. So everything we're talking about today is on the real estate side. And just shout out to Sorenson. We've been thankful for their partnership and things they've put together, focusing on rural community. It's nice not to be alone out here working in these rural areas. So next slide, please. I believe the slide deck is going to be made available to everybody, so I'm not going to read all of our bios, but a couple of things. I mean, emphasizing the importance of a team, both the fantastic partners that I have. I was the founding partner of the fund, have a real estate background. My partner, Stephanie Copeland, who I think many of you know is a partner in the fund, but she actually came out of the Hickenlooper's office in Colorado when the opportunity zones were designated, had a chance to be involved in leading the designation of those opportunity zones. So the perspective of coming from government of where should these zones be, and then joining us and actually implementing this has been a important thing for us as we've learned about opportunity zones. It's been a new process. We also have some great advisors. One of the advisors from Zoma Capital, they've also provided a line of credit to us. Access to capital in these rural areas prior to, chicken or the egg, right? You have to have money to take down projects. You need projects to raise capital. They've provided a line of credit to us that was really important and instrumental to moving us forward when this was first getting started. Next slide, please. So let me tell you a little bit about our investment thesis. We're investing exclusively in Colorado at the moment. We may at some point do some connected states, but the regional focus is important when you're in these rural areas. You have to be boots on the ground. We're outside of the Front Range, so everybody's familiar with Denver and Boulder. People are not necessarily as familiar with Florence or Meeker or Grand Junction or Natarita, some of the places that we've actively invested into. But there is real unmet demand in these communities. There just hasn't been as much opportunity before. So you don't want to use the word opportunity too many times as we talk about opportunity zones, but the opportunity is there in these communities. Multifamily housing is the most significant piece of what we're doing from an equity perspective. Huge need in many of these communities. We're in a state with significant population growth, and the disparity between the haves and the have-nots has just been exacerbated, as I think most people have seen over the last well, for a while now, but it's really accelerated with the haves and the have-nots. Most of what's getting developed is truly capital A affordable housing as federally subsidized, or luxury in many of these areas. Some for sale, single family homes, but very little rental family, rental multifamily that's available. So we're developing that, and we're really trying to right size it for the demand. We have some 16 unit projects, some 50 unit projects, generally a bunch of 100-unit projects that are going into these various communities. Outdoor hospitality developments are within proximity to outdoor attractions. We're not investing in Aspen or in Steamboat where I live. Those are not in the zones, but the proximity to those is bringing people in, and it's creating and fueling job growth in some of these communities. From a financial perspective, I mentioned the impact motivation. We live in these communities. We want to make a difference, but opportunity zone projects, as Rachel mentioned, as you're raising money, the projects really need to stand on their own. These are pretty standard projects from a real estate return perspective. We're targeting 6 to 8% cash on cash return once these get stabilized. That generally will result over the 10-year hold in a 2.5, 3 times equity multiple, paying standard preferred returns that are pretty standard in the industry of about 8%. And then I think the most important number that comes out of this is when we look at projects and we look at the fund, we're targeting a low teen IRR, which is a time-based return on your capital over that 10-year hold period. And any number that we talk about is always net of fund fees and before the opportunity zone benefits. The OZ benefits are huge, but they don't mean anything if you're losing money, right? No one needs a tax incentive if you're losing money. You can already write that off. What we're doing is we want it to be an apples to apples comparison to another investment that you might make, knowing that the OZ benefits of, it's generally 300 or 400 basis points are going to be layered on top of that after that 10-year hold period. But it is attracting long-term patient capital is really the core of what the opportunity zones are designed to do. And that time period allows us to weather the storm if we end up, where we are right now, right? High inflation, high interest rates. If we were merchant developers trying to sell into the market, we'd probably be stuck. Fortunately, we're long-term looking at this, 10+ year hold period. And that's a really important piece of this as we decide which communities and which projects we can invest into. Next slide, please. This is probably the most fun slide for me. This is what we have in either developed or in development. Little map of Colorado here. You're all familiar with Denver. The black numbers are housing units. We have almost 900 housing units that are being developed across the state. And then on the hospitality side, in the white circles, those are all active projects. With the one exception down here of number 5 in the lower right, which is where I'm sitting today. Well, that one's going live next week. All of our hospitality projects are open and operating. About a third of our housing units are already developed and operating as well. So you can see it's a lot of, one of my partners calls it a lot of windshield time. It's really important in these rural areas that you're on the ground working with the community. We're not coming into a community and dictating, hey, this is what your need is. We're coming into the community trying to understand what the need is, working with the local and economic developers, the local community, local investors in many cases who are investing alongside of us. Next slide, please. So tangible examples of what we're building. These are recent pictures. Grand Junction over on the left is the largest. It's the largest city out on the western part of Colorado. We have a 96-unit housing development, 100% leased in the first 60 days. And that's been, I think, the most important number that we've seen from there is that we went into this with a strong, really, clear numbers around demand, strong belief in the demand in these properties. But a lot of new development hasn't happened. We'd go talk to the bank and they would say, hey, please show us 3 other properties just like this, right? Well, they didn't exist. But to be able to prove that, to be able to have it built, have it operational, and have it 100% leased in the first 60 days is actually ahead of schedule from a lease-up perspective. And it's really been a nice tailwind for the next development that we're doing. The one in Glenwood Springs is very real time. You can see opening November 1st. Open November 1st, 75% leased upon opening. And these are typically, most of these are 1-bedroom and 2-bedroom units. mid-market, the market rate rents. These are not targeted at a certain subset of the AMI. We're not subsidized where we're targeting 60 or 80% AMI. These are market rate rents, but they're designed for that missing middle, people with solid jobs. You probably need to update that picture because it's not dirt anymore. People can actually park there. But it's nice quality new product in great locations, and those locations are certainly important from a real estate perspective, but the ability to attract the capital and to do this would not have happened in several of these markets without the opportunity zones. Next slide, please. Similar hospitality portfolio, multiple projects. These tend to be smaller instead of, $25, $30 million projects like the previous screen. These are, $2 million projects, $3 million projects, $4 million projects, things that you frankly could not have done in a single asset fund. They're really too small, but they make a strong impact in these communities. They happen to be, many of these are right alongside the communities where we're also doing multifamily, and being able to go into it as a multi-asset, multi-investor fund is what's enabled us to take on some of these smaller projects that have a real impact in some of these smaller communities. We can't go build 100 units of multifamily housing in a town of 2,000 people. Doesn't make sense. But if that town has, lakes, rivers, hot springs, some of those things that are attracting people in, we can build outdoor hospitality that creates jobs and provides, increased tax revenue for these communities as well. So I won't talk a ton about the hospitality portfolio today, since most of it's going into housing, but it is an important piece of what we do. Next slide, please. So our current fund, one of the things that's been interesting for us is when we first started talking about our fifth fund, we started talking about it as a multi-asset fund. We had several projects that we were pursuing. We're now, we're just in a different market than we were certainly a year ago, even 6 months ago, driven by inflation, but really it comes down to interest rates from a real estate development perspective. We have, because of that, we've had to be really selective about what projects can really go forward. Rents have generally increased some, which can be hard on a community, good for an investor. But the costs have been high and have stayed high, but our financing cost has more than doubled in the last year. And because of that, we've had to be increasingly selective about our projects. And we've taken two projects that we thought were going to go forward, and we've moved them out of this fund. We have one project that's far enough along that we already own, where the numbers, even with the high interest rates, still look attractive. So we're moving it forward. But part of the due diligence for us investing in these is to do, there's no guarantee on any project, but to do the due diligence and to only select projects that we think have the right return. So in this case, where we are right now, we've done multiple funds. We probably wouldn't have done as many funds if we really understood more about the timeframes of Opportunity Zone investors into those. We did a series of time-based kind of 6-month funds early on. We've now extended that to really yearly funds. The time matters. You don't want someone from 2019 being on the same clock as the 2023 fund, because they already have to be holding it for 10 years. So we're currently raising a single asset fund. We just started this in September, have raised about a third of the money, little over $15 million that we'll be raising for a single asset. This is a multi-family greenfield development in a housing market that has, it's a constrained market with significant demand. And I just mentioned pivoting to the single asset. The fund is, they talk about open-end funds and closed-end funds. Really, with an Opportunity Zone fund, we're going to close the fund as we raise, as we complete the raise. So we continually take money in. In the Opportunity Zone world, it's really about the time frame of the investors. When do they, you're on the clock with your 180-day gain. They need to be able to put that money in while they're on the clock. So we have a rolling close as investors invest into this fund. And then we'll do, as we've already purchased the land. We'd actually purchased it with our line of credit. Now that we've, so in this case, it's, Rachel had all the slides of the different types of funds. We've done several of those types of funds. This one happens to be single asset with the asset already acquired. That's generally easier to raise money for. The economy right now, the uncertainty of everything from inflation, politics, et cetera, makes it harder to raise money. So it's nice to be focused on a single asset that an investor knows exactly what their money is going to go into. Next slide, please. What this fund is for a town called Idaho Springs. Some of you may have heard of that. It is not in Idaho. It is Idaho Springs in Colorado. This one's actually our closest project to the metro area. It's about 30 minutes away from Denver. It's midpoint between Denver and the mountain area. This will be one of our largest projects in terms of number of units. We've been targeting around 100 units. This one happens to be 119 units. Raising the money now, acquired the land. We'll be breaking ground in the spring. You don't want to break ground in December or January in Colorado typically because we get a lot of snow up here. But this is a project where we've been able to select the GC. We're working on locking down final pricing. We've been expecting that at least the pricing on subs in the supply chain would typically be dropping at this point. The supply chain's been a little wonky at this point, so prices have stayed high. We are seeing some other projects in the market go away, which at some point will reduce the cost of some pieces of the project. At the same time, interest rates are very high, so we're in the process of locking down both the pricing and the debt in real time as we're talking about this. It's a cool town, great downtown, amazing outdoor access. Little over 45 minutes from some of the major ski areas. And people want to get out into these areas, especially with all of our projects will have good Wi-Fi. It's very attractive to location neutral, true location neutral workers or people that just want to be a little bit outside of some of the urban areas. But this is a specific example of what we're raising for right now. A lot of our investors do come from, they either come from or have specific ties to Colorado, but many of them don't. We're primarily raising from high net worth individuals that believe in the project. They understand. I think it starts with the fact that we're in Colorado in an attractive place from a population growth and a demand perspective. And then it also has to do with liking the specific project and then ultimately believing in us as project sponsors and project developers. But anyway, that's the specific project that we're doing from within this fund. Next slide, please. So I know I'm kind of just talking about what we're doing, but we were asked to be really specific about what are investors actively doing in these rural areas. So that's a brief snapshot. There's more projects. I could talk all day about the projects because that's just what we do all day is develop these and keep these moving forward. Looking forward to questions both now and at the end. I'll make sure and put my email into the chat later. There's a email that's on the slide here. That's our investor relations person. If you're an investor, please email them. You're more than welcome to. But I'll put my direct email in there as well. If anybody has, certainly investors, we'd love to talk to you. But really anybody with questions, we love sharing information about what's happening with opportunity zones. It's been a crash course for all of us since this didn't exist until a few years ago. But happy to be here and happy to answer any questions.
Yeah, much appreciated, Chris. And there are a few questions that came in during your presentation, so we'll get to those. But I just wanted to share, from my perspective, when I hear, multifamily rental and hospitality, my eyebrow kind of cocks because I'm like, is that really impact? But I think it's because maybe I'm thinking about it from more of someone who lives in a metro area and what I see around me, right? Like big Marriotts or fancy hotels or, a Class A apartment building with all the amenities. And so can you just describe, for folks who maybe aren't in the rural or emerging community state of mind, how important it is to have these types of assets or invest in these types of assets for rural communities?
Yeah, I think that's a great question. It's where we actually spend a lot of our time too. And when we talk about impact, we want to explain the impact in the community. But if we talk about impact too much for the investors, if we were an impact fund, that means, oh, you're targeting a lower return, right? And so we're always striking that balance as an impact motivated fund. So I live in and grew up in rural areas, both in Colorado and in Texas. I'll talk about housing first, but then I'll talk about jobs. The Grand Junction, the first project property that I showed on the screen, the first one that we rolled out a couple months ago with those 100 units, that's one of the first projects that's come all the way through and been built certainly in that part of town. It was an industrial part of town. The city's really been working to revitalize it, and we're the first for rent development in that part of the town. You know, I mentioned I was a previous real estate investor. I still own rental property in this area, but it's generally, you know, 70, 80-year-old single family housing. It's a very different, you know, we try to keep it nice, but it's just a different dated project. It's not going to attract, you know, you end up with some of these towns getting older in rural areas. You see a lot of statistics about towns getting older. They're trying to figure out, how do they attract people? How do they attract younger people, people that have jobs that aren't just service industry jobs or lower paying jobs? And a lot of that has to do with, you know, in Colorado, a lot of it has to do with mountain bike trails and with rivers and with things like that. But it also has to do with real quality housing, right? They want to know that they can come in here and have a quality place to live. We're not building in fancy amenities. I mean, we do have a very small workout center, and we have you know, some laundry areas. But really the amenity is the location, and it's expensive to build. It's hard. I mean, I think my ending point for rural development is it's really hard. It's easier to develop in a place where the rents are higher and the demand is already proven, especially from a lending perspective. So to come in and build housing and have that housing, it's just one little piece of the puzzle. But if we're building the housing and someone else puts in the brewery and someone else does childcare, we're really trying to move that whole ecosystem forward. But it starts with housing for us. And in the town where I live in Steamboat, there's a town 45 minutes away where most of the service workers live, right? They cannot afford to be there. And there's some real nice efforts going on from the local community housing development that, you know, is federally subsidized, federally and state subsidized. And then it has a lottery, and 500 people apply for the 60 units. And that's the reality of them trying to find housing. If we can come in, again, we don't invest in that community, but if we can come into the opportunity zone communities and on a for-profit basis provide any housing, 100 units in a town of, you know, we're doing Buena Vista, it's a 3,000 person town, and we're putting 100 units in there. It makes a real difference for their ability to bring workers in. So to me, everything comes back to workforce in terms of what we're trying to do. From a hospitality perspective, you know, we're not putting luxury hotels in. We're doing some really cool, fun stuff, but it's rural. It's in some cases it's even remote, which is one step beyond what we think of as rural. We're creating jobs. I mentioned the 80 jobs that are out there, but it's, you know, it's tiny homes on tiny homes. It's RV parks. It's hot springs. It's micro hotels that have been you know, we bought a hotel for, man, a few $100,000 that was renting out for like $30 a night and going on a cash basis. Those are not, it's great that it's affordable, but they're so affordable that really they're not being maintained, right? And so if we can take something that's not been maintained and turn it into an asset for the community, we view that as a financial win for us, but also a real win for the community, that it's going to attract more people in, and in some cases remove an eyesore as well. And those are the kind of impacts that we're trying to make in these communities, but do it on a for-profit basis that can compete as we try to attract capital and strike that balance. It's a challenging balance everywhere, I think, but it's especially challenging in these rural areas. And some of our projects can only go forward with some level of, certainly with support from the community, and sometimes with incentive. Most of them are just pure for-profit. We've got equity and debt and maybe some mezz debt, but on some of them, we also have some waived fees or some incentives and some support. Those things really matter in these rural areas.
Yeah, I think that's well said. And I think a lot of folks can relate that are working and doing economic development in rural communities around issues of not having comps. And maybe it's a, you know, the first new start in 20 years, and, you know, what that does to financing or being able to get a deal to close. So I think there's going to be more questions, but I do want to allow Sarah from Indiana to speak. I do have like a real quick prompt before Sarah goes on, but also want to say that there are some questions in the Q&A box, and we will definitely get to those at the end. Thanks so much, Chris.
Thanks.
And so another group that was part of the Rural Opportunity Zones and Recovery Playbook was the Purdue Center for Regional Development in Indiana. And they had launched a project called the Rural Opportunity Zones Initiative. And they've gone through multiple cohorts. trying to build community capacity for the state of Indiana's rural opportunity zones. And so they published a few months ago their sort of lessons learned after going through these cohorts. And so we have a few bullet points there, but we'll drop the link in the chat so folks can go ahead and take a look at their lessons learned and maybe get some tips. I also want to say another link in the chat that we'll put in there is EIG's work around the state of Indiana and delivering opportunity to Indiana. We did a big report on that in late 2020. So that may also be a good resource that is still timely and for your use. One of the really wonderful people that I met when I was working on that delivering opportunity in Indiana report or resource was Sarah Brigato from Switzerland County in Indiana. And I got to meet up with Sarah and we grabbed coffee and I got to go and like talk to the local large employer in Switzerland County. And I'm so glad to have her on to talk about what her lessons learned have been from sort of a community and economic development standpoint, and then also share a little bit of information about a project she has been working on and continues to work on in an opportunity zone in Switzerland County. So Sarah, I will turn it over to you.
Hey, Rachel, thanks for that. I'm going to have to get you back there for a visit again. That was really fun. Like Rachel said, I'm Sarah Brigato. I come from, well, I've lived in Switzerland County for 35 years. Like lots of rural people, I've worn a lot of hats. I was the founding president of the Switzerland County YMCA, which is the smallest area to build and support a full service YMCA. I was also the founding director of the Regional Children's Advocacy Center, which was the first planned regional advocacy center in the state of Indiana. I also led the broadband task force and developed an after-school Spanish program, and am currently working with Southeastern Indiana Regional Planning Commission to develop their economic resiliency plan. And we're almost done. And when we get done with that, we're going to work on our community housing development organization to try and figure out more efficient ways to bring housing to low-income folks in our 9-county region. And right now I'm the interim CEO at that YMCA. So here's Switzerland County. It's the opportunity zone map. You can see that. And our opportunity zone is that little smudge down in the bottom right-hand corner there. It's as you can see, if you know opportunity zones, it's a lot of geography. We as a county, we have around 10,000 people. That's 44 people per square mile. That's a whole lot less than the national average. And I think the Indiana average is about 190. The geography, we're 220 square miles of rolling hills. The glacier didn't hit us, so we are ancient hills and valleys. They're not really good for farming, but really nice to live, really scenic. On the river, we're just about halfway between Cincinnati, Ohio, and Louisville, Kentucky, but we are in neither of their metropolitan service areas. And our biggest industry is the Belterra Casino Resort. It's a really big, lovely casino right on the river in the opportunity zone and across the river from the steel plants. Okay, next slide, please. Now that's a blow up of our opportunity zone. You can see the green part on the east side is the opportunity zone. It's about 83 square miles and it's cut north-south through the county, and is on the bottom is the Ohio River. It's a strong working community. It has a 3.5% unemployment rate. It has a low cost of living, like almost 20% lower than the US average. It's low in crime. As I said before, it's close to Cincinnati and Louisville. And our limitations are that we have a low per capita income and a high ALICE rating. And the ALICE rating is asset limited, income constrained, employed. 44% of our population are at that level or under the poverty level, and that's a lot of folks. It's more or less means working poor. But quality of living there is high. Okay, next slide, please. Oh, we're there. Okay, that when we worked with Purdue Center for Regional Development, they developed a really great prospectus for us, and it mostly had mixed use projects and housing projects, and they were well planned and well positioned, but we just didn't get much traction on them. And I believe some of the hurdles we faced when we're developing these plans is that we don't have an executive government or office. We're too small to have a mayor. So plans have to, they don't have any office or position to marshal them through election cycles. So the plans, they just don't have a central voice, nor do we have a central vision for the county. We don't have a group of people like a mayor that can plan and just plan these projects with developers and things. We also have insufficient broadband, but we did get a nice grant from the state and partnership between two co-ops, REMC, the electric company, the rural electric company, and SEI Communications partner together, and they are starting to provide broadband to our region through that grant. So it's great. We're getting it. But what could really help is if we put together some investment funding for the pre-development and feasibility and needs analysis. So when projects started to get together, or if somebody was interested in a project, we could get going more quickly. Okay, next slide, please. Okay, one of the projects we started to develop after the prospectus was done, we began looking at, rather than trying to develop projects to lure people and businesses into the county, but rather to look at what we had and make housing and the quality of life better for our workforce. So we have two workforces there in the opportunity zone. One is the lower paid service workers that would work at Belterra, and the other are these high paid employees of the steel plants across the river. I forgot to mention, in Kentucky, across the bridge, which is right in our opportunity zone, Kentucky has a lot of steel plants, and Dow Corning, it has 100,000 seat NASCAR track, and they're building a regional airport. There's a lot going on in Kentucky. And often Indiana people go over there to work because the jobs are good. But people who work in those plants would rather live in Indiana because the quality of life is better and the taxes are lower. So we have that to work with. So for those steel plant workers, the concept is to build market rate housing for them in the same project as light tech housing for the service workers at Belterra. And for all of the housing, we would develop a child care center on site, walking distance. So everybody could work and the children would be well cared for. We hoped that child care center would be paid for through EDA new business funds. But even with all that, the first investors we had looking at it, the developers, thought that the project was too small for an unproven market, and it's harder to do small projects, just like Chris said. And these particular developers were from Alaska, and they just thought managing that project, the construction and management of the ongoing maintenance and things, if they had to do that from Alaska, it was just going to be too much work. And the rents were too low because the cost of living is low, so it would require more funding. And they believe that they go for qualified census tracts that can give them a 30% boost in tax credits, but it only works for them if it's 100% tax credit project. So the mixed income wasn't really good for them. Their opinion, however, was that there's definitely an opportunity, but best tackled by locals with vested interest in seeing their community thrive. And I already mentioned all the hurdles there. I really like this project because I believe that by having both populations that need housing in the same place and then having their children play together and get to know each other will elevate the future for all those children and hopefully for their parents too. And it's kind of based on the Coleman report out of the Civil Rights Act, but that works. And I think it would be a better place for the workers who live in Switzerland County already. But I think it could also be very attractive for people who want to leave urban places to live in a rural place for the lower cost of living and higher quality of life. It could draw some of them, and we could diversify our workforce and our income streams through that. So it's my pet project, and I'm still plugging away at it. And I will take any questions.
Yeah, thank you so much, Sarah. And I am glad, very, very happy that you're still plugging away at it. I think it is such a great example of sort of the scale you can get to when you're co-locating different uses or co-locating housing for different populations. And the other thing that I really like about it is that it includes what like folks are calling, employer sponsored or employer supported housing, even if it's not going to officially be that, it's the employer potentially playing a role in providing that housing adjacent to the job opportunities that it's offering. And so I think it's just a really great example. And I remember when I was out there, we had been talking about this sort of trifecta of needs. I'm throwing up like a trifecta sign, but this trifecta of needs where you needed broadband, you needed employers, and you needed housing, and one couldn't go without the other. They were all so interrelated. And so can you describe that a little bit more? And just because for me, it was like a aha moment, but I'm wondering if it would benefit others just to hear your perspective on that.
Well, we noticed, of course, during COVID that so much of the population, especially this 44% of the low income folks, had no access to COVID. So they were getting left out of school and jobs. They couldn't apply for unemployment. There was just a great vacuum for those people, and things were getting worse. And so if you could marry the improved broadband with improved housing, then everybody's going to do better. And one thing we have in Switzerland County is that when we have low income housing, it's usually just low income housing, and it's backed away in the back behind other housing, and the people are kind of segregated from each other. And so it's not a good way for anyone to learn about each other and learn other ways of doing things. So it doesn't really help with breaking the chain of poverty. So if you could provide equal opportunity to all the residents in housing and broadband and friends, they have a way better chance of breaking out of that chain. Is that what you were asking?
Yeah, definitely. Just the interdependence of all three of those things. And if you don't have broadband, it's hard to attract employers, and it's also hard to attract new residents. So you need that amenity in order to attract those things. In order to attract employers, you also need sufficient housing stock so that they can have employees, that is, desirable for those employees. And in order to attract employees, again, you need jobs. So you need that employer, and you also need that broadband. And so this triangulation between broadband, major employers, and housing, there has to be an investment in one of those things without the other two things, in the hopes that the other two things come along after. That was my takeaway. Hopefully I'm not butchering it, but yeah.
No, and the work we're doing in the resiliency plan is kind of backing all that up, that having improving quality of life for the whole region is, it just is a more sensible way of economic development for small communities.
Yeah, absolutely. Well, Sarah and Chris, I want to thank you. We are at time. We're actually 1 minute over. For folks, as we're saying goodbye, if you want to take a look at the Q&A box, we had been answering questions throughout the webinar, and just want to thank you guys for your engagement. And Catherine, I will turn it over to you to officially close us out.
Yeah, thanks, Rachel. Thanks as always for moderating a great conversation. Thank you to Sarah and Chris for joining us. I think it was really helpful to hear your insights on your work in rural communities and some of the challenges, but also the opportunities that exist in many of these places in emerging markets. So thanks for your work. Thank you for sharing it with us today. Thanks to everyone for attending today's webinar. As I mentioned at the beginning, this was recorded, and so we will be posting a recording as well as a recap of the discussion and the slides just within a week or two on our website, and that will also be in your inboxes as registered attendees. So thanks again for joining, and we will have more again next month. So stay tuned for that. Have a great rest of your day. Thanks all.